Hey everyone, thanks for checking in. This is Stock Investing and Trading 101, and today we're going to be discussing credit and debit spreads. I'll be explaining why you'd want to open one of these, what they're used for, and I'll show an example of a trade that I entered yesterday using a credit spread and I exited today. Essentially what they are is a spread of two options that you open at the same time. So I can explain with the credit spread first what you're going to be doing is using either calls or puts, it doesn't matter. You are going to be buying one contract, so I'll be buying a $1.59 call, and against it I will be selling a $2.28 put for a total credit of 70 cents, which would be $70 for opening this position that you're paid. And essentially what you're doing when you're opening a credit spread is you're betting on the market direction going one way or another. So with this, I'm using calls. I sold a call, so I want the market to go down or sideways. I don't want these calls to become worth more in value because this one will outpace the other one and you could take a max loss. There's always a max loss with this trade, so it's limited risk. There's also limited reward. And what this does then is it opens one position and the value of it moves depending on contract value, and it expires here. There's different expiration dates. This one expires June 28th, and when it expires worthless unless it's in the money. So with this contract, it's in the money right now, and you can always calculate that value by going to your well, it tells you the break even here if you're the buyer, but for the seller, it's the exact opposite. We can discuss that in a different video, but essentially you are betting on it not going up when you're doing this with calls, and if you're doing it with puts, it's the exact opposite. Then you're betting on the market going up and not down. The reverse of that would be a debit spread, and I can show you guys that. We'll do a debit spread this time with puts. We'll close out this position here, brand new position. So using puts on a debit spread, what this is you're going to be buying the $1.01 put and selling the 70-cent put for a total cost of 32 cents. And it's moving right now. This would be $32 to open, or 33. And why you'd want to do this would be, first of all, to reduce your cost basis. If you wanted to trade these options at face value, you'd be paying $100 or $70. This way you can trade these options with limited capital. Also, it limits your risk to less risk. This is your maximum risk right here, which is very good. And it also limits your reward. So it is a risk-reducing trade, an income-reducing trade, and it's typically just a safer trade than just playing one leg of an option. Why you'd want to do this is, again, to reduce your cost basis, or another example would be if you're entering a put position on the SPY, but you didn't want to risk if you're buying this put for $279 and you think this is a good option, you think it's going to become, worth money, but you don't have the whole $300, you could still play this option by doing a debit spread with these two, and essentially you'd be paying $74 and you'd be still playing the option. So you could sell this one and buy this one, you'd pay $75, and if this goes your way, you could make a nice chunk of change. I typically don't trade spreads all too often unless we're at highs or lows or there's a really good opportunity. I'll show a spread that I opened yesterday and I exited today, and why I did it. We were close to highs and have been shaky all week, either sideways or downtrending, and I wanted to take advantage of if the market went down. So I opened a call credit spread for $10 here on the SPY. Show the legs I got into for that and how I got out of that trade for a profit. What I did was I sold the go. I sold the $26 call and I bought the $16 call for a net credit of $10 when I opened the position. You can see the filled quantity right here. And this contract expires today, so that's why I opened it mainly. I bought the contract and it expired on me the next day, so I could have made just $10 as long as the market didn't make a $2 gap up, and I saw high probability for myself. And I could have waited because it would have expired worthless today, assuming the market doesn't make a huge run in the next 4 hours. Instead, I bought it back. I closed the position for $4. So I only took a net credit of $6 when you factor in. I got paid $10 to open the position. I bought it back for 4, and so I took a net credit of $6. And that's something I wanted to discuss, is that you can always buy the position back. If it goes to 1 cent, I typically always will buy my position so I can just take the net credit. Because if it's down to 1 cent, you may as well just pay the dollar and close the position so you can put the money to better use. And you've almost made a max profit. There's no need to be overly greedy with it. So like I said, I don't trade spreads all too often, but they can be very useful, and there is some people who are very consistent with the spreads. I like covered calls more, which is an income producing strategy that I'll be discussing in my next video. It's great for all my dividend investors and income investors. It's exactly what it's for. It's low risk, limited risk, income producing strategy with options, and it's one of the only ones that I think is a safe option strategy. These are good, but it's just not my strategy. My strategy is different, and everyone has their own trading strategies. So I hope you guys like this educational type of video. I'm going to be doing more videos like this with more complex and in-depth strategies. Please comment below if you have any questions. Check out my other videos and subscribe to the channel. And yeah, stay consistent, guys. That's what it's all about. And let's end up green for the year.